Hey, so we're midway through quarter two here in 2022, and we're looking at year-to-date. The S&P is down about 13%. And I love Vanguard research, and so I always like to go back and look through some of their economic data and their market analysis in times like this, because even as a financial advisor, I know that we're supposed to focus long term, but it's unsettling to watch your portfolios drop, even as a professional. So I wanted to point out a couple of things that I found interesting in a report Vanguard put out recently. So since 1980, there have been 9 bear markets. Bear markets are declines of 20% or more for about lasting at least 2 months in the market. So there's been 9 bear markets. So of the bear markets, the average length is about 236 days, and the average return is negative 28%. So that's a 28% drop on 236 trading days. On the flip side, the average bull market lasts about 852 days, and the average rate of return is 99%. So, when you think about that in a very long-term perspective, are you willing to take a 20% drop at times for a 99% gain? That's what it comes down to. And obviously, most of us say yes, but living through it's a whole different story, right? And there's ways that you can counteract that. Obviously, short-term bonds right now would help with that, not to lose as much as the stock market. Another interesting thing is some of the 20 best trading days. So you look at each calendar year since 1980. 20 of the best trading days actually occurred in negative return years. 20 of the worst trading days actually occurred in the best or positive years. So just because we have a bad day doesn't mean it's going to be a bad year. Just because we have a good day doesn't mean it's going to be a bad year, or vice versa. So the bottom line is that we have to stay focused long term. We have to keep our costs low in the portfolio. Vanguard helps us do that. We carry a lot of their funds, but also BlackRock and some of State Street funds. Average expense ratio for us is around 5 basis points, or 0.05 of 1%. And we also maintain a very diversified portfolio. So not only do we carry just large cap stocks, but we mix that in with foreign and small cap real estate, all things that are supposed to kind of move separate. But in this period that we're in right now, we're actually seeing everything correlate to one, where we have the market falling. We also have the bond aggregate, a representation of the entire U.S. bond market is also down. At one point, it was down as much as stocks, just because of rising interest rates and what that effect is on bonds. So as we go through the rest of the year, I don't have a crystal ball. I don't know what's going to happen with stocks and bonds. I do know over the long term that as an indexer in the portfolio's, that we are going to win. I know that. I just don't know what's going to happen in the short term. So short-term money, this is why it can't be in the market. Short-term money needs to be out of the market. It needs to be put somewhere safe. And then your investment portfolio is something that you should never have to touch for maybe 5 years. Doesn't mean that you can't take some cash and have that set aside inside your investment portfolio for reserves. If you're a business owner, you always should have business reserves set aside. But the important thing here is that we stay invested, we stay focused long-term. When we're going to get through this just fine, as long as you don't sell and panic. So keep a positive outlook. Keep looking at the S&P 500 chart over the last 10 years, 5 years, 3 years. It's a great graph, and we'll get through this shortly. Thank you.